Hello and welcome to our webinar on the tax obligations of non-residents. This webinar has been prepared for informational purposes only. It was prepared also for educational purposes only. This presentation is not legal or tax advice, nor is it to be construed as such. Each individual's circumstances are different. You should seek legal and or tax advice to address any specific questions you may have. My name is Jimmy Sexton. I'll be your presenter today. A little bit about myself. I have a bachelor's in business administration, a JD, an LL.M in international taxation. I am the president of Esquire Group, an international tax advisory firm with offices in Austria, Germany, the United Arab Emirates, and the United States. We specialize in international taxation, including tax issues facing U.S. citizens and resident aliens living abroad, expatriation, investing or doing business abroad, and foreign investment in the U.S. I'm fluent in English and German. If you want to know a little bit more about me, you can check out my profile on our website. The link is available at the bottom of this slide. So, today's webinar is going to be about the tax obligations of non-residents. So, in order to determine what the tax obligations of a non-resident are, we first have to define who a non-resident alien is. So a non-resident alien is a non-U.S. citizen who does not meet either the green card test or the substantial presence test. So the green card test is basically a non-U.S. citizen that has a United States green card. If you are a non-United States citizen that has a green card, then you would be considered a resident alien and not a non-resident alien. The other test is the substantial presence test, which is essentially where a non-resident alien can become resident alien simply by spending too much time in the United States. Now, the substantial presence test calculates days over a 3-year period. And essentially, if a person who would otherwise be a non-resident alien spends 183 days in the United States over a 3-year period, then that person would become a resident alien. And the 183 days is not calculated simply by adding up the days over a 3-year period. Rather, if the person has spent 31 days or more in the United States during the current year, you would add up all of the days in 2017, this being the current year. You'd add a third of the days from the prior year, so a third of the days from 2016, and a sixth of the days from the year before that, which would be 2015 in this example. So if the total of all the days in 2017, a third of the days of 2016, and a sixth of the days of 2015 equaled 183 days or more, than that person would have met the substantial presence test. So a non-resident alien is somebody who is not a United States citizen, does not meet the green card test, and does not meet the substantial presence test. So when does a non-resident alien have to file a U.S. tax return? There's generally 3 criteria or 3 situations in which a non-resident alien would be required to file a U.S. income tax return. The first would be if the alien was considered to be engaged in a U.S. trade or business, and we're going to talk more about what constitutes a U.S. trade or business. If they had received U.S. source fixed determinable annual or periodical income, for short FDAP income, on which the tax liability was not satisfied through withholding. We'll also talk more about that, or to claim a refund, and we'll talk a little bit more about that as well. So these are the 3 situations in which a non-resident alien would generally be required to file a U.S. income tax return. So the first of those criteria was if the non-resident alien was engaged in a U.S. trade or business. So if a non-resident alien was engaged or considered to be engaged in a U.S. trade or business, then the income from that U.S. trade or business would be considered what's known as effectively connected income, or ECI. So some examples of effectively connected income would be performance of personal services in the U.S. This is essentially being employed or self-employed in the United States, or being a partner in a partnership that is engaged in a U.S. trade or business. So for example, if you had, let's say, a non-resident alien who was a resident of Germany and lived in Germany but invested in a partnership that operated a restaurant in Los Angeles, that restaurant would be considered a U.S. trade or business, and the income from that restaurant would be effectively connected income, and this non-resident German partner would be required to file a tax return to report his portion of partnership income. Owning or operating a business in the U.S. that's selling services, products, or merchandise would be considered a U.S. trade or business, and the income therefrom would be effectively connected income. Gains and losses from the sale of U.S. real property interests. So if you had a foreigner who was a non-resident alien that sold a piece of real estate in the United States, that would be considered effectively connected income. Also, U.S. rental real estate income is generally FDAP income, but there is an election that can be filed to treat it as effectively connected income. So if a non-resident alien is required to file a U.S. income tax return because they have effectively connected income, then they would be allowed normal deductions and credits, much like a U.S. resident would be allowed when filing their regular U.S. income tax return. One of the key differences between resident tax returns and non-resident tax returns is that if a non-resident does not file an income tax return within 16 months of the due date, the IRS can deny any deductions and essentially charge tax on the gross income. The non-resident alien would be filing Form 1040 NR in this case. If the non-resident alien is receiving effectively connected income, the non-resident alien would have to give a Form W8 ECI to the U.S. payers of that effectively connected income. So for example, let's say that we go back to the example of the German national and resident who's partners in a U.S. partnership that operates a restaurant in Los Angeles. That German partner would have to give a W8 ECI to that partnership operating that restaurant in Los Angeles. If the non-resident alien fails to provide Form W8 ECI, that will generally result in 30% withholding on any income that is payable to that non-resident alien from the U.S. trade or business. Also, in order to have a valid W8 ECI, the non-resident alien has to have either a U.S. Social Security number or a U.S. individual taxpayer identification number, which is better known as an ITIN, and we'll talk a little bit more about ITINs later in this presentation. So, just to recap, if a non-resident alien has effectively connected income with a U.S. trade or business, they would be required to file a U.S. income tax return, Form 1040, and pay tax at graduated U.S. income tax rates, just like U.S. citizens and residents. If they didn't file the tax return within 16 months of the due date, the IRS can deny any deductions that could otherwise offset that income. So the next category of income that could trigger a filing requirement for a non-resident alien is what's known as FDAP income, as mentioned before. So FDAP stands for Fixed Determinable Annual or Periodical Income. So fixed means that it's paid in amounts that are known ahead of time. So a perfect example of this would be a royalty for licensing a trademark, where you pay a certain amount of revenue. That would be something that is fixed because it's a fixed amount of revenue. Determinable is there is a basis for figuring the amount paid. Again, a royalty would be a perfect example in that 10%. Periodic means that it's paid from time to time, meaning maybe paid monthly, biannually, annually. Annual, it does not actually have to be paid annually or in regular intervals. It can be paid from time to time, as mentioned under periodic. And periodical can be determinable or periodic, even if the time between payments is increased or decreased. So it can still be FDAP income even if it's paid on an irregular basis. So some common examples of FDAP income are compensation for services. Commissions, for example. Commissions would be determinable because they would generally be a percentage or a fixed amount based off of sales or something of that nature. Dividends, interest, pensions and annuities, alimony, real property income such as rents if that election to treat it as effectively connected income was not made. Royalties, as I mentioned in our example, scholarships and fellowship grants, as well as other grants, prizes, and awards, sales commissions, and partnership distributions or allocations of FDAP income. So you had a non-resident that was partners in the U.S. partnership, and that partnership received FDAP income, then it is possible that the non-resident alien would have to file a U.S. income tax return if sufficient U.S. income tax was not withheld. So taxation of FDAP income that is not effectively connected with a U.S. trade or business is taxed differently than effectively connected income. So as I mentioned before, effectively connected income is taxed at graduated tax rates, just like a U.S. citizen or resident would be taxed. FDAP income is generally subject to a 30% flat tax on the gross amount. Now, certain countries have tax treaties with the United States that can reduce that 30% flat tax, in some cases down to zero. Now, the U.S. payer of the FDAP income is generally required to withhold and pay that withheld tax to the IRS. So, for example, let's say you had a U.S. corporation that was paying a dividend to a resident of Panama. Panama does not have a tax treaty with the United States, so the default withholding rate of 30% would apply. So let's say that this U.S. corporation pays a dividend of $1,000 to this Panamanian resident. The way that would work is the U.S. corporation would have to withhold $300 in tax and pay that to the IRS, and the remaining $700 would get sent to the Panamanian resident. There are no deductions and netting against FDAP income. So, for example, if you had some type of deductions that might be able to offset the FDAP income, you would not be able to take those deductions. The FDAP income is taxed at a flat rate, either this 30% or the lower treaty rate. Now, in the example that I gave, the Panamanian resident would not be required to file a U.S. income tax return because all of the tax liability was satisfied through withholding. If you remember at the beginning of the presentation, I said that a non-resident would have to file if they received U.S. source FDAP income and the tax liability was not satisfied through withholding. So if the full tax liability was satisfied through withholding, then the non-resident alien would not be required to file a U.S. income tax return. So going back to the example of the Panamanian resident receiving a dividend from a U.S. Corporation, let's say, for example, the U.S. corporation did not withhold the 30% tax and pay it to the IRS like they were supposed to, and they paid the entire $1,000 dividend to the Panamanian resident. Because the entire tax liability was not satisfied through withholding, that Panamanian resident would then have to file a U.S. income tax return form 1040 and report that $1,000 dividend and report that there was no withholding on it, and then pay that 30% tax on that dividend. Non-resident aliens are generally not taxed on their capital gains except in very limited circumstances. So for example, if you were a non-resident alien and you bought and sold U.S. stocks, those gains from your U.S. stock sales would not be subject to tax in the United States. Generally, non-residents are only taxed on gains in the United States if they're connected with a U.S. trade or business, or if it's gains on real estate or certain contingent payments from the sale exchange of patents or copyrights, or gains on the transfer of patent rights in certain situations. Non-resident aliens are required to provide for W-8 BEN to the U.S. payer of FDAP income. So in the example that I gave with the Panamanian resident receiving a dividend, that Panamanian resident would have had to have provided the U.S. corporation paying the dividend with a form W-8 BEN. Failure to provide form W-8 BEN would result in 30% withholding, which really doesn't make much of a difference if the payment is already going to be subject to 30% withholding. But where failing to provide the W-8 BEN can sting is if the person would have otherwise been entitled to a lower treaty rate. So in the example that I gave, since there was no tax treaty between the United States and Panama, the dividend being paid from the U.S. corporation to the Panamanian resident would have been subject to the default withholding rate of 30%. Let's change that example and let's now assume that it was a U.S. corporation paying a dividend to a resident of Germany. Now, the U.S. and Germany do have a tax treaty, and let's assume that the withholding tax rate on dividends paid from the United States to residents of Germany is reduced from 30% to 15%. In that situation, the German resident, who is a U.S. non-resident, would provide the U.S. corporation with a W-8 BEN, and on the W-8 BEN, he would input that he was a German resident relying on the U.S.-German income tax treaty to qualify for this lower withholding rate of 15%. When the U.S. corporation then paid the $1,000 dividend, rather than withholding 30% tax and paying it to the IRS, they'd only withhold 15% tax, or $150, and pay that to the IRS, and the remaining $850 would be sent to the resident in Germany. Now, if that German resident had failed to provide a W-8 BEN, then the default 30% withholding would have applied, which brings us to the next reason that a non-resident alien would be required to file a U.S. Income tax return, and that would be to claim a refund of overpaid or over-withheld tax. So let's say that we're going back to the example of our German resident. He qualifies for reduced 15% withholding, and let's say for whatever reason the U.S. corporation withheld 30% rather than the 15%. That German resident, who was a non-resident to the United States, could file a Form 1040 NR claiming that treaty benefit and the reduced taxation rate of 15%, and then would receive a refund of the over-withheld 15%. If a non-resident is required to file a U.S. income tax return, they would be filing Form 1040 NR Form 1040-NR is due on April 15th if the non-resident alien received wages subject to U.S. tax withholding. So basically, if the non-resident alien worked in the United States and received wages from employment and got a W-2, then the due date would be April 15th, like most other Americans. If the non-resident alien did not receive wages subject to U.S. income tax withholding, then the due date for the tax return would be June 15th. There is a 6-month extension available to file Form 1040-NR. However, the tax must be paid by the original due date of the tax return, so April 15th or June 15th, whichever the case may be. Also, if the non-resident alien does not have a U.S. Social Security number and does not qualify for a U.S. Social Security number, then they would have to obtain what's called an individual taxpayer identification number, or ITIN, in order to file their 1040-NR. If they don't already have an ITIN at the time they submit their 1040-NR, they can submit a Form W-7 with the required documentation with their Form 1040-NR to apply for an ITIN. Some tax obligations of non-residents that are often overlooked are the U.S. gift and estate taxes. I'm going to talk briefly about both. First, I'm going to talk about the gift tax. So gift tax only applies, U.S. gift tax only applies to non-resident aliens on U.S. tangible property and real estate. So U.S. tangible property is basically property located in the United States. So, a car, art, something like that. U.S. stocks and bonds are considered intangible property and are not subject to gift tax. So if a non-resident alien owned a portfolio of U.S. stocks worth $10 million, they could gift that to whoever they wanted completely tax-free because it's intangible property and not subject to U.S. gift tax. So assuming that the property would be subject to gift tax, so U.S. tangible property or real estate, a non-resident alien can give an unlimited number of $14,000 gifts to as many people as they want. So they could give $14,000 to 10 different people, and there would be no filing requirement for either the non-resident alien or the recipient of that $14,000, and there would also be no tax due on it. If, however, the gift of U.S. Tangible property real estate was over $14,000, since non-resident aliens do not get a lifetime gift tax exclusion, which is a tax-free amount that Americans get that they can gift throughout their lifetime. Any gifts over the $14,000 would be subject to 40% gift tax. If a non-resident alien spouse gives U.S. tangible property or real estate to a U.S. citizen spouse, that would be a tax-free gift up to an unlimited amount due to the marital deduction. However, that does not work the other way around. If a U.S. citizen spouse tries to give assets to a non-citizen spouse, even if they have a green card, the tax-free gift would be limited to $149,000 a year. Any gift above that $149,000 in a year would reduce the U.S. citizen's lifetime gift tax exclusion of $5.49 million. And if it exceeded the $5.49 million, it would be subject to 40% gift tax. There may be some relief under U.S. estate and gift tax treaties, but that would depend on several factors. Estate tax differs from gift tax a little bit in that U.S. estate tax applies to all U.S. property owned by a non-resident alien. So that's much like the gift tax, it applies to tangible U.S. property and real estate, but it also applies to intangible U.S. property. So the U.S. estate tax would apply to U.S. stocks and bonds. Now, the U.S. does give non-resident aliens an estate tax exclusion. However, it is only $60,000. So any U.S. assets owned by a non-resident alien, if that non-resident alien dies, they're going to be subject to estate tax at 40% of the fair market value on any assets over and above the $60,000 exemption. Again, the U.S. does have several estate and gift tax treaties, so there may be some relief available, but generally would be the fair market value of the non-residents' U.S. assets that would be subject to U.S. estate tax at 40% on anything over and above the $60,000 exemption. If the recipient of the inheritance is a U.S. citizen spouse, then the U.S. estate tax would not apply. They could inherit an unlimited amount of money from the non-resident spouse due to the marital deduction. However, much like with the gift tax, that does not work the other way around. If a non-resident alien, if a U.S. citizen left their non-resident alien spouse in inheritance, it would be the normal rules that apply. Again, there may be some relief available under the treaty. There's also some other relief that's available. For example, if the non-U.S. citizen spouse became a U.S. citizen, then they could possibly qualify for the marital deduction. You can also use what's called a qualified domestic trust, which basically delays the payment of estate tax. So that brings us to